So hello friends, hope all of you are doing fine. I am very happy to share that the feedback that we've got for our ETF Ke Funde series has given us the energy to share many such interesting videos and try and help investors decode the way of investing. What we had observed was there were a lot of questions when we had released our first episode ETF Ke Funde, and investors had this doubt of how ETFs are different from index fund and how investors should approach investing in both these categories of fund. So we thought let's try and decode both index funds and ETFs in today's discussion and make this session an increased learning on both these fund categories. So first, the similar aspects of ETF and index fund. Basically, both index funds and ETF track the performance of an index. So what it basically does, it mimics the performance of the index. So both ETFs and index funds try and mimic performance of the index. The idea is not to generate alpha or additional returns compared to the benchmark, but to give beta or similar returns of the benchmark. So this is a very similar aspect of index funds and ETFs. From now, a lot of things will differ between index funds and ETFs. So let me explain what are the differences in both index funds and ETFs. So first is it traded like a stock or a security? So the answer for index fund is no, while for the answer for ETFs is yes, because an ETF, like we've explained in our previous video, is a fund which is traded on the exchange like a security, and hence you can buy and sell it on the exchange like a security. Now the logical question that will come to your mind is, at what price can you buy it? So in the case of an index fund, the purchase price for an investor is the closing NAV of the fund on the day his investment is made and the realization of his funds has happened. I think so this is a very important thing that investors need to consider, because as per the changes that we've seen in regulation, now the investor is going to get the NAV based on realization of funds irrespective of the size of investment. While in the case of an ETF, investor is actually buying on the exchange, and because he is buying on the exchange, an ETF is like a security which will have prices during the entire day. So if market were to go up, it will have a higher price, and if market were to go down, say in the afternoon, it will have a lower price. So you can enter or exit at different prices like you buy and sell a security. Ideally, the price of the ETF that you can buy on the exchange will be closer to the indicative NAV of the fund. Now this will arise a question in your mind is, what is an indicative NAV? So most asset management companies will have on their website feature enabled through which investors can come to know the closing NAV of the fund and the indicative price or NAV of the fund based on the volatility of markets. So investors can use that as a reference point to understand what is the price they should buy the ETF at. Now the question is where they can buy this fund from. So an index fund has to be bought from an AMC, while in the case of an ETF, it can be bought from the AMC. So for large investors at a particular price, they can send a purchase subscription or a redemption subscription directly to the AMC. But for smaller units, even as small as 1 unit, investors can buy and sell the same security on the exchange. So the trading is done on the exchange. Now comes to the next point of portfolio disclosure. So for index funds, the portfolio is disclosed in the case of equity index funds on a monthly basis, and it is available on the AMC website. However, in the case of an ETF, and again with respect to equity ETFs, the portfolios are disclosed on a daily basis on the respective AMC website. So investors can get the higher transparency of the portfolio when they buy it from the route of a ETF. Now I think so the point comes to intraday trading. Intraday trading is not possible in case of index funds. It can be possible for an ETF. Of course, investors should not try and do intraday trading, but if an investor wants to trade in an ETF, he can even trade during the day. Essentially, all of you understand that equity as an asset class is volatile in the short period, but over a long period of time, volatility goes down. Hence, the ideal time for investing in equities is always 3 to 5 years, and that's what investors should do to try and get a better experience. Now, I think so a lot of questions were there on the expense ratio. I think a clear point that we want to highlight is, in the case of an index fund, we've seen historically that the expenses of index funds are higher than the expenses of ETFs. I think so investors should check the expense ratio and they can check it across AMC websites as well as financial websites to know the difference of expense in the direct plan or the regular plan for an index fund and the ETF. One thing investors need to keep in mind is, for buying an ETF, investors need to have a demat account. So I think so that is something that investors need to take note of. While the index fund can also be bought through a demat account and can be held in the normal physical nature as it is. There are a lot of questions people have, is that I can do SIP in index funds while we cannot do SIP in ETFs. Absolutely true that you can do SIP in index funds and investors can get the advantage of staggering their investments and investing in a disciplined manner. What we've observed is that now a lot of brokers have created such a way of order systems that a lot of securities can also be bought in a systematic manner through them. So if investors want to do SIP in ETFs, they can do it with the help of their brokers and also continue this systematic way of investments. We've seen time and again that by staggering your investments and investing for the long term, the experience of investors has improved significantly, and we believe an SIP way of investing, both in index or ETF funds, is good for the financial experience and the performance of the investor. Now, coming to the main part of what we believe provides ETF the edge over index fund is the ability to get better purchase points by taking advantage of corrections of volatility in market. I had highlighted this point earlier that you can enter at an intraday price based on the volatility in markets. We have slides to explain this point in detail. The point we want to highlight in the slide here, which is in front of you, will show that whenever markets are volatile, we've seen many days where market has been more than even 2%, 5% volatile between the day low point to the closing price of the index. And then if an investor gets the entry point right, he can get a better entry point than the closing value or NAV of an index fund. So investors who have that acumen can take advantage of market volatility by buying an ETF. By doing this, this provides significant advantage for an ETF compared to an index fund. We want to highlight to investors is that investments should always be based on investors' time horizon, their risk profile, and their return expectations. The investor should consult their financial advisor on which product is suitable for them. In today's discussion, we've shared key elements of both index funds and ETFs. We would like investors to make informed decisions on what product will be suitable to them based on their credentials. Thank you everyone for having patient listening, and hope you continue your learning through this series of videos of ETF Ke Funde. Please continue sharing your views and feedback, and don't forget to subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.